Imagine one day you walk into your office and your boss tells you that we have just hired an assistant to help you with most of your work, especially those mundane and repetitive work that you don't like. And that assistant is a robot that does work with high precision and speed, so that you'll have more free time to do more strategic, creative, and value-adding work and thinking. How nice would that be? And would it be nicer if I tell you that the software company that is helping your company to do all this robotic automation is publicly listed and growing very fast, and that you can invest in it to profit from the worst shift towards automation? That's why today we are talking about one such company, UiPath, which went public in April 2021 with a ticker symbol PATH, Path. In particular, we will talk about what does UiPath do, the things we like about UiPath, and the things we don't like about UiPath, including its current valuation. Before we start, I would really appreciate if you can help to hit the like and subscribe buttons so that more people get to know about this company. It takes a long time to research the company and prepare the video, and your support will go a long way in motivating us to produce more videos on good companies to own. So let's talk about UiPath now. UiPath was listed on the New York Stock Exchange in April 2021, and its share price now is around $73, which is similar to the price on its first day of trading. This translates to a market cap of about 38 billion now. UiPath essentially helps companies to automate processes using its end-to-end automation platform. The special thing about it is that it uses computer vision technology to enable its software robots to read the computer screen so that they can then emulate what people do. After reading the screen, artificial intelligence and machine learning technologies are used to examine what processes or actions can be best automated. And if the users decide to automate them, they can do so easily, letting the robots run in the background and intervene as and when needed or as alerted by the robots. So UiPath allows users to discover processes that can be automated, and it makes it very easy for the users to then build automation processes in a codeless drag and drop environment. So think about it as something like an Excel macro function where you can record what you do and then ask the computer to repeat it for many times. But this is much easier, and this extends to a lot more applications and capabilities. The users can then manage the automation processes at a firm level to determine which processes to develop, test, and deploy in the firm, who within the firm have access to what automation, and monitor the results and return on investments on these automations clearly in a dashboard. And companies usually do this by setting up a center of excellence to manage and coordinate all these automations. Users can also engage easily with the software robots to do various automations and monitor them centrally through various applications developed by UiPath. There are actually many use cases for such automations, and many Fortune 500 companies in different industries like Bank of America, Adobe, CrowdStrike, DHL, and General Electric have been using UiPath to automate many of their processes. Now we'll talk about 7 points that we like about UiPath. The first point is that its land and expand model allows it to grow exponentially with the customers. Generally, when a customer first starts using UiPath, the customer will deploy the robots in a single department first, targeting a few use cases to test the robots out. When they are comfortable and see how easy and effective they are, they will expand the use of automation to more departments and more use cases and more users over time, until the automation platform is fully adopted by the whole company with engagement from the C-suite due to the large benefit reaped by the company. At that point, the client company becomes highly integrated with UiPath at a firm level, resulting in high switching costs, which makes them very sticky customers. As UiPath charges the clients based on the number of robots deployed and the number of users using the robots, so when the client companies start using more and more robots across different departments, UiPath gets to earn more and more revenue. UiPath also generally collects the revenues 1 year in advance, so that's good for working capital and cash flows too. The land and expand model combined with the usage-based pricing model results in UiPath having high dollar-based retention rate of 145% in financial year 2021, which is the 12 months ending January 2021. This means that in financial year 2021, the cohort at the end of financial year 2020 was spending 145% of what they spent in financial year 2020 as they use more and more robots. And the gross retention rate was also high at 97%, which means that only a few customers drop out, with most of them renewing their annual subscriptions. And if you look at some of the customers here, after 2 to 3 years with UiPath, they were spending 4 to 70 times what they spent at the start of their journey with UiPath. How nice is it to acquire the customers, and then they continue to spend increasingly more and more with you without you actually doing much more. All these result in the existing cohorts spending more and more revenues over time, driving high revenue growth for UiPath. with a CAGR for revenue standing at 86% from financial year 2019 to financial year 2021. Meanwhile, the number of large customers also grew, with the customers spending more than 100,000 a year, growing rapidly to about 1,000 customers now. And there were also 89 customers that spent a lot of money of more than 1 million a year in financial year 2021. The second point we like about UiPath is that according to market research by Forrester, UiPath is the leader in this market now, and probably the largest, competing with Automation Anywhere, which is a private company. Microsoft is also in this game, following closely behind. There's also another publicly listed company in this space called Blue Prism in the United Kingdom, but it is much smaller than UiPath at about $1 billion US dollars market cap now. UiPath customers are saying that they chose UiPath because UiPath has the most complete solutions and deliver a lot of value swiftly, easily, and inexpensively, sometimes saving them up to a few $1 million a year. The third point we like about UiPath is that it has already established an extensive ecosystem of 3,700 partners, much more than the 2,200 partners for Automation Anywhere, the next largest competitor. UiPath has many technology partners like Oracle, Microsoft, SAP, Adobe, and AWS, where it integrates its technology with theirs so that they can automate processes easily across different applications. It also has many business partners globally, like Deloitte and Accenture, to help it to sell and deploy the solutions to the end customers and maintaining them, thereby allowing UiPath to grow fast. And UiPath also has its own academy, with many people participating in its courses and forum, and with its marketplace offering lots of pre-built automations that can be easily downloaded and used instantly by the users. And in May 2021, it has also launched its first automation school in Ireland to teach students about software robot technology and make people familiarized with its technology and solutions. The fourth point we like about UiPath is that its total addressable market is large and fast growing. In 2020, the market was estimated to be around $17 billion, with UiPath taking just less than 4% of the market share, with many companies having not used software robots for automations much yet. And the market was projected to grow fast, doubling to 30 billion in 4 years by 2024, driven by various tailwinds. The fifth point we like about UiPath is it has a high gross profit margin of 89% in financial year 2021. It spent a lot on operating costs, so it's still loss-making, but those costs have come down significantly as it scales over the years. If we assume that some of the sales and marketing and research and development expenses are for growth purposes and not needed for maintaining the existing cohorts, UiPath can actually be quite profitable if it wants to stop growing fast. Its sales and marketing expenses include commissions paid to business partners like Deloitte and Accenture for selling and doing the maintenance for customers. It's unclear what's the commission structure, whether the commission payments are recurring or one-off, such that there can be some operating leverage there. We have checked with the company but have not heard anything from them yet. Now, if we assume that 50% of the sales and marketing expenses are required for maintenance, instead of a lower percent, say 25%, because we are unclear on the commission structure, and then we also assume 75% of the R&D expenses are required for maintenance, then UiPath has a normalized profit margin of 17% before tax or 13% after tax. As UiPath continues to grow in scale, it is possible that it could achieve a net profit margin of, say, 15% to 20% in the future with operating leverage, and we'll consider a 20% figure later in our valuation exercise. The sixth point we like about UiPath is that it has already hit a positive free cash flow margin of 4% on a non-GAAP basis in financial year 2021, with it earning 26 million of free cash flows that year. So it might be able to use its organic cash flows to fund future growth instead of having to raise much more money that could dilute existing shareholders. The seventh point we like about UiPath is that the CEO, Daniel Dines, who is the co-founder, still owns a large percentage of the company at 21%, which is equivalent to $8 billion worth of value based on a rough share price of $70, so that he actually has a lot of skin in the game. UiPath also has a strong board of directors, which also owns quite some shares in the company. For example, Excel, a venture capital firm, owns 19% of the company, which is worth around $8 billion. And Capital G, a private equity firm under Alphabet, or more commonly known as Google by many people, owns 6% of the company, which is worth around $2 billion. Now let's talk about the 3 points we don't like about UiPath. First is non-executive directors, who are directors who don't have executive roles in the company, were paid a lot of money as compensations in financial year 2021. The stocks awarded to them were worth around $1 billion to $5 billion. And most of these non-executive directors have only joined the board in that financial year. I would say that that's a lot of money, even if they have strong experiences and reputable background. If we look at the compensation policy for the non-executive directors, they are paid an annual cash retainer of 30,000 a year, which is fine. Then they can be given restricted stock awards of around 400,000 on initial election, and the total annual compensations are actually capped at 1.5 million for the first year of election, or 1 million a year in subsequent years. So how can the annual compensations in financial year 2021, which we have just seen, be as high as $5 million, exceeding the 1.5 million cap here? That's because this compensation policy was only adopted in April 2021, after they have already paid themselves a whole load of stock awards. So instead of giving the board lots of free shares to incentivize them to grow the value of the company, I would personally prefer the board to pay for those shares from their own pocket, even with some discounts given to them, instead of just from shareholders or companies' money, so that we can see that the board is actually willing to put their own skin in the game. The second thing we don't like about UiPath is its related party transactions. In August 2019, UiPath hired the CEO's brother, Aharon Times, to provide specialty security services to the company. Aharon was paid cash compensations of 58,000 in financial year 2020 and then 123,000 in financial year 2021, which was still not excessive. In those 2 years, he was also given restricted stock units and options that were valued at about 620,000, making the total compensation to be about 0.8 million over the 2 years. Now his services start to be looking quite expensive for just security services. Not only that, those restricted stock units and options were valued at a low value then when UiPath was not publicly listed yet. If we use the current share price of say around $70, the total compensation over the 2 years actually came up to 2.2 million, which is definitely a lot for just one guy's services. The question is, why would you pay someone providing security services shares in the company instead of just giving them cash? It's definitely not because the company didn't have enough cash and wanted to save some cash outflows, because UiPath in financial year 2020 was actually incurring an operating cash outflow of 360 million, and saving just 1 million compared to that, with the 1 million being the originally valued amount, wouldn't actually have made any difference at all to the company's cash flows. The third thing we don't like about UiPath is its current lead-rich valuation. UiPath share price is around $70 in May 2021. Using its diluted share count, the market cap is around $39 billion. This translates to a very high price to sales multiple of 65 times. Let's dig into this more to see what that high multiple means. From the current market cap of 39 billion, if we as investors want an annual return of 15% a year, then the market cap of UiPath has to compound at 15% a year. And if we project out 10 years later until financial year 2021, that means the equity value of UiPath has to be 159 billion for us investors to earn 15% a year. If we assume that we are willing to pay a PE multiple of 25 times, then UiPath have to achieve a net profit of $6.4 billion. If we assume that the net profit margin then could be 20% by reference to our analysis earlier, then UiPath has to earn a revenue of 32 billion then in financial year 2031. To broadly hit that revenue target in financial year 2021 from its revenue of 600 million in financial year 2021, UiPath has to grow its revenue by 60% for the next 5 years and then 40% a year for the next 5 years to achieve roughly that kind of target revenue. Now, there's a lot of growth baked in. I'm not saying that it's not possible for UiPath to achieve it, but it probably requires almost perfect execution and has minimal margin of safety. So the current valuation is definitely very rich with a lot of future growth priced in, and investors have to decide whether they want to pay for this. So we have talked quite a bit on UiPath today, on the 7 things we like about it and the 3 things we don't like about it. Overall, it's probably not worth paying the current rich valuation, so it might be worth just sitting out and continue to monitor the operating performance of the company over the next few years and see whether the high board of directors compensations and related party transactions continue to go on. In the meantime, there are wonderful businesses that are available at much better valuations today. For example, StoneCo, which Berkshire Hathaway has invested in, Wix and Upwork, all of which are fast-growing companies with strong moats and tailwinds, which we have covered in our channel, and I'll provide the link to those videos in the video description below. So be sure to check them out. So what do you think of UiPath? Do you like the company and would you like to buy it? Let us know in the comments below. And if you have enjoyed this video or have learned something, please help to smash that like button now if you haven't, and subscribe to our channel if you want to be notified of future videos on UiPath or great companies to own. Thank you, and we'll see you in our other videos.
Do join us in our investment forum on Facebook, using the link in the description below, where we discuss lots of interesting businesses and investing concepts. Do check out our multi-bagger research series of the link in the description below, where we discuss in detail great businesses to own and compound your wealth for the long term. These great businesses have high growth in revenue, profits and free cash flows. For example, this global payments company has grown at a compounded annual growth rate or CAGR of 60 to 80%, while this technology company has grown its revenue at a CAGR of 80%. And this other payments company has grown its revenue and profits at a CAGR of 20+%. Check out our comprehensive option series course on options strategies to complement long-term investing at link in the description below.